Does investing in stocks sound too difficult? Do you think you need to follow the investment shows on TV or the latest stock tip online? Do you need to eliminate all investment risk when heading into retirement? Joseph Hogue joins us to dispel these investing myths and more, showing us that investing in stocks can be a lot simpler than we might think. Welcome to the MapleMoney Show, the podcast that helps Canadians improve their personal finances to create lasting financial freedom. Today's show is brought to you by Borrowell. Not too long ago, I used to have to fax in my request to get my free credit report by mail once a year. Now I get my report and score for free online, saving me a lot of hassle. Get your free credit score at maplemoney.com/Borrowell. Now let's chat with Joseph. Hi, Joseph. Welcome to the MapleMoney Show.
Tom, great to be here. Thanks for having me.
So I wanted to have you on. I know you do a lot of YouTube videos around investing in the stock market. And while you're primarily talking about the American stock market, it really doesn't make a difference. Canadians can invest in American stocks just like Americans can invest in Canadian stocks. So what I'm hoping you can kind of get us through is some of the sort of myths or investing lies about the stock market.
Sure. Well, there's really three misconceptions, I think, and they're actually kind of lies that are perpetrated by by the industry. Whether you're on Wall Street or in Toronto with the TSX, it really has to do with benefiting the industry and the people in the industry. And we can go over these three misconceptions, these three lies, but it really has a lot to do with the fact that investing has really become an entertainment industry. And it's really started from the 90s when people found out they could get rich with internet stocks, right? So investing really became a Main Street game, and you had these channels like CNBC pop up and all these investing websites that really perpetuated these lies for the sole purpose of getting investors hooked on daily stock picking and analysis and worrying about a crash. So one of the first lies really that you see, especially when like myself, when you do work in the industry, and I worked with venture capital and with private wealth management for a little bit more than a decade, and you see that they want you to believe that investing is about returns, those double-digit returns, and picking the next hot stock. And of course, this just goes to if investing is about returns, then you're going to be glued to the TV to find that next hot stock, to find those double-digit gains or even those triple-digit gains, which is that mythical 10 bagger that's going to multiply your money. And what happens is that and a lot of these other lies, they lead to the just horrible investing decisions. Researcher Dalbar actually puts out a study every year on average investor returns. And they just released their 2017 one. And what it found is that the average investor made annualized 4% over the last 10 years. So every year, about an average of 4% return. And that's against a stock market return, even including the 2008 crash of about 10% on stocks. So, that huge gap of about 6% from what the market actually produces and what average investors are actually getting is because of a lot of these lies, because they're chasing stocks, they're trading in and out, which of course runs up those fees. And it's really something that eats into returns. And really the only people that get rich off of it are the people in the industry, the brokers that are collecting those fees every time you trade, as well as the websites and the TV stations that are selling those billions in ad revenue from so many eyeballs being on that every day.
Yeah,
so that's really personal.
I've always been a big fan of sort of ETF investing or any kind of indexing for this reason, because if you're constantly chasing that stock, I've never really watched those TV shows, but I have to assume by the time they're talking about them on TV, even if it's a daily show, it's already kind of too late, right?
Sure. And you get people on there, and it just kind of breaks my heart because you see a lot of these very well-respected hedge fund managers and professional investors, liability. I won't say his name, but he's got a show on CNBC that where he just leans on buttons that scream buy, 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 and sell, sell, sell. And it is just the wrong message to be sending to regular investors. And it brings us to our first really investing rule that is what investing is really all about, and that's just a goals-based strategy. So many people think that investing is about that returns-based strategy, about chasing stocks and getting those returns. Well, what are you investing for? You're not investing for just for the pure money of it. You're not investing for those to see those digits run up in your investing account, because it's ultimately meaningless. You're investing for what you're going to use that money for. You're investing for your goals. So and that's really what people need to bring their investing back to, is that goals-based strategy. And of course, that starts with understand what your goals are. One of the biggest problems with investors is that they have these vague goals, like, oh, I want $1 million by the time I retire, or I just want enough money I don't have to work anymore. And that's fine, but how motivating is that when budgeting gets tough and when you can't make that deposit in your investing account? The problem is it's that goal, it's so vague, it just means nothing to you. So what you need to do, what I tell everybody to do, is to actually sit down with their partner, their spouse, whoever's has whoever's going to be with you in these goals, and actually create a mental picture around your goals. What does retirement look like for you? Where are you on, and what are you doing on a daily basis? Who are the people around you, and even down to the emotions and what you like to do, what retirement is going to look like for you. And that's going to do two things, really. One is that you're creating this mental picture around your retirement, or around your goals, any goal, really. It may be watching your son or daughter walk across the stage at their college graduation because you had that money to pay for that. So that's going to be so motivating. Whenever budgeting gets tough, whenever you're thinking about not depositing in your investing account that month, you're going to take out that mental picture, and it's going to motivate you to do what you need to do to keep investing and stick to your plan. But also what it's going to do is going to give you a concrete idea of what you're actually going to need in retirement. It may be close to $1 million, or it may not, but it's going to give you an exact dollar figure around this mental picture to be able to plan on the rest of your investing strategy. So that's really that first investing rule. It's got to be based on a goals-based strategy.
Yeah, I like that idea, instead of just this random number. And really, when you look at the numbers, like you said, someone's getting 4%, but the market does 10%. That math alone just tells me, like, just average sounds pretty good. Just stick with the average of the market.
And that's I think that's why a lot of this passive index investing, the Vanguard, the Bogleheads investing has been so popular, because getting that market return is actually beating the market, if you consider the market is the Main Street investors.
Yeah, and really that's less effort than trying to constantly watch these shows or get these newsletters and trying to constantly find the next thing of the day.
Absolutely. And the second Wall Street lie, really, that you hear is that you have to worry about a stock market crash. And this one is everywhere, especially times like now, when it appears that maybe the economy might be coming down a little bit, and we might get some kind of a stock market sell-off. And again, it keeps people glued to the analysis. It gets people trading in and out of stocks and trying to beat the market. And what people see is that investing is so much more about what you put in, and then getting the free money that we'll talk about. But if you look at a regular portfolio, if you put in monthly deposits, then it is actually about 20 years. If you're making around a 7% annual return, it is about 20 years before those earnings on that portfolio become equal to or greater than what you've put in. So you could see, over 20 years, 2 decades, it's basically, a very nice return on a savings account. And a lot of people, they start investing, they want those double-digit returns, and then they get disappointed when they make even 6, 7, 8% returns. They get disappointed. Why am I not making thousands of dollars already on returns? And that leads to obviously frustration, disappointment, and they just stop investing. when yeah, you have to remember, investing is just as much about what you put in as it is your returns that you make.
Yeah, for sure. And yeah, when it comes to timing the market, I've never sold based on timing, but I've been a bit guilty of trying to buy based on timing.
Sure.
Because I get the idea that a market crash or even just bad news for a company can be a sale, but sometimes it's still not bad to buy during them. But maybe there's even further to go. So it's
Oh
still
yeah, oh yeah. I've been there. I've
yeah.
been there. I definitely, and it's a big problem. It's one of the reasons why I suggest you never have more than 5% of your total wealth or your stock portfolio in a single company, because everybody likes to talk about a dollar cost averaging, where you buy a stock for $100 and then maybe it comes down to 80 or 70, and you're like, well, if I liked it at 100, I love it at 80, and that means my average cost now is 90, so it doesn't have to come up quite as much. Well, yeah, you can follow a stock all the way down, and pretty soon you've got 40, 50, 60% or more of your money in that stock, hoping, dreaming that it just comes back to even. It's basically kind of the gambler's trap, right? Where you're just trying to get even. And I've seen a lot of portfolios wiped out by people chasing a stock all the way to the bottom, and it never quite comes back.
Well, and speaking of sort of these investing myths, one I've heard a lot is this stocks are like gambling. You mentioned the gambling, and I guess it's that kind of chasing the loss that where it does start to look a lot like gambling. But in general, people get this idea like, oh, I'm not even going to start investing because it's just gambling.
Sure. Well, and I think that that does have a lot to do with these misconceptions and lies, if you will, that the industry puts out on investors. That because in that respect, it is a lot like gambling, where you're trying to chase those big returns. But if you do look at it as a goals based strategy, a long term strategy, investing in different assets and a diversified portfolio, like we'll talk about, then it's much less. It's much more like a savings account with a very attractive return, really.
Yeah, exactly.
And then part of that savings account idea, and part of that idea of getting everything you can out of it, is getting that free money, really. And we have the retirement accounts, the Roth and the IRA in the U.S., and I understand you've got the RRSP and the TFSA there in Canada. Some of the best investing decisions you'll ever make. I it always amazed me when coworkers didn't take advantage of the maybe a 401k plan with a company match, or some of these other retirement accounts, because anytime you can get a company match into your investments, or get those tax benefits, that is an immediate return on your money. And then with the TFSA, a great return in the future.
Yes.
So there's no professional investor is ever going to be able to beat the returns you'll get with a company match, or some of these tax advantaged accounts.
Yeah, well, I'm a big fan of RSP and TFSA because yeah, why pay the taxes if you don't have to?
Definitely.
One thing I often tell people, without getting into their exact situation, because then it could depend which one's better for them. But if they put their money into an RSP as an investment, then they can get that tax refund, and then they can take that tax refund and invest that in within a TFSA. So they're getting a little bit of both, basically off free money, as you were talking about.
Excellent.
Yeah.
Yeah, definitely. And yeah, I think a lot of people look at that. Obviously, everybody likes something now. Everybody likes that immediate deduction, and it's the same way here in the States with the IRA and the Roth. But they don't pass up the power of that tax-free retirement money. Um, you know, Even just having some in both is going to help you be flexible, manage your taxes in retirement, and can be an amazing tool. Besides the fact that I would actually prefer pay my taxes now, and then get all my returns tax free, because in that RSP, you're eventually paying taxes on those returns, right?
Yes.
When you
Yes.
when you withdraw. Well, with a TFSA, if that money is tax free in withdrawal, then that's while you're paying taxes on your contributions, that's never any taxes on your returns. So, I mean, in my book, that's so powerful.
And that's where people are catching on to. The amount you can contribute is only 6,000 right now a year, but it's been over a decade now. So it's starting to get to the point
Sure.
where if people are invested in the right thing and not just some low interest savings account, not chasing stocks, but at least being invested in stocks, that they're starting to see that TFSA has some value in
Now,
retirement.
Now, do they have the conversion with an RSP there? Where, okay, so for example, here, then you can contribute. You only contribute about 6,000 a year to both combined. So you can do
Okay.
3,000 each or 6,000 at one. Um, but you can convert as much as you want out of that IRA into a Roth. Uh, in a year. So
Yeah,
basically, the idea is that you put all your contribution in the RSP and then convert it into a TFSA whenever you want. Do they
yeah,
have that?
you can't do that here because if you
Okay.
there's no conversion, and if you pull money out of an RSP, it
Mm.
you lose that contribution room and you're taxed on it as soon as it.
Oh, okay. Okay.
So the TFSA is great, but they don't let you kind of double dip that way. You pretty much have
Uh-huh.
to make that decision up front.
Okay.
So one
But
thing you
still,
could
still,
do.
still great ones.
Yeah, well, one thing you can do if you're lower income, you're just starting a career or something, you could be putting your money into a TFSA because the tax refund isn't as helpful to you yet. But you can always pull money out of the TFSA and invest in RSPs in the future. So just to get a better
Yeah.
tax refund as your tax bracket goes up. So
Yeah, and I think that's one of the benefits up there than it is, compared to the U.S. options where they're both locked up until you retire. You can't take money out of your Roth or an IRA
yeah,
until 59 and a half without penalties.
yeah,
So that's great to be able
TFSA
to do
is
that
really
anytime.
fluid. Yeah, I use TFSA. I use a portion of it as my emergency fund too, because I can pull
Excellent.
the money out if needed. So at least it's gaining. Hopefully, I don't need it, and then if I ever do, it's totally accessible. So
Excellent. So,
let's go to the next myth you
okay.
had.
So the final lie here is that you have to listen to the analysts and you have to play that stock market game. And obviously, this benefits the industry because it's the one churning out all that analysis and giving those six-figure jobs to all the stock pickers. And that idea of playing the stock market game, beating the market, when in fact, obviously that just perpetuates that cycle of the average investor getting about half of the actual market returns. Uh, and in fact, investing doesn't have to be that complicated. Just a system of gradually adjusting your money over stocks, bonds, and real estate over decades. In fact, I've got friends that basically look at their investing account maybe once every 5 years, maybe every 10 years, even for all of about 2 or 3 hours. They'll go back in. They deposit into the account every month, and they've got it set up to where their portfolio, their deposits are spread out over their portfolio, so they're constantly investing, but they're not even worried about what stocks are doing or picking new stocks or anything like that. They're in those broad-based ETF funds, and every 5 or 10 years they'll go back, they'll reimagine those goals that they have, that mental picture, and make sure that their portfolio of stocks, bonds, and real estate are matching those goals as far as risk. And they'll make some adjustments, maybe, because okay, so obviously you start out as a 20-year-old, hopefully investing, and you're able to take on much more risk. It doesn't matter. You're going to live through two or three, four market corrections or even stock market crashes. Um, and it really doesn't matter. You've got the time to rebound with stocks, so you're going to have most of your money in stocks. Well, what happens is 30s, 40s, and 50s, your risk tolerance, your tolerance for those big stock market crashes or that money moving back and forth uh, gets limited. You're going to need the money pretty soon. Maybe even some of your goals, like that college education, is becoming something that's within the next few years. So the idea shifts from growing your money to protecting the money that you've grown, to having your money there when you need it. So you gradually shift from that stock portfolio into stocks and bonds and real estate. Uh, and it's so important, and something I think so many people put off. They see, okay, they might even understand the idea, but they'll go from their 20s to their 30s, or their 30s to their 40s, and say, I mean, my goals haven't really changed that much, and I don't need to change my portfolio that much. I'll do it, when I'm 50. Well, when 50 gets here, they put it off again, and when 60 gets here, they put it off again, and pretty soon it's 2008, and they still have 80-90% of their money in stocks. And it's a really a tragic story for millions of people that that lost half their portfolio because they were getting ready to retire, and that stock market crash just wiped them out.
Yeah, that makes sense. That's when timing can be a problem if you're not sort of, like you said, getting a little safer into things like bonds. At the same time, though, I've seen people be overly cautious and say they retire when they're 50 or 60, and they go all bonds, and and then now they've kind of taken on a new risk, which is that their investments aren't even going to keep up in inflation, and they could be alive another 30 or 40 years. You're right. That's all about balance. Like you
Sure,
got to make
sure,
sure that it
absolutely.
works both ways.
Sure. Even someone, moving into retirement, a lot of advisors will recommend that they have at least 30 to 40% in stocks, just to beat that inflation, and so forth. Now, a lot of times you'll see recommendations on a purely stock bond portfolio, and I think if you divvy some of that up into stocks, bonds, and real estate. And of course, real estate, it doesn't necessarily mean you have to invest directly into properties, but you can get some great real estate exposure through what's called real estate investment trusts.
Mhm.
They have those. Well, you can invest in U.S. market.
No, we have the
So
exact
these.
same thing too.
Oh,
In
okay,
Canada, they're exact same thing. REITs. It's
sure.
yeah. Go ahead.
Yeah, so basically, you get that same exposure to commercial real estate. That there's a great cash flow investment, and excellent dividend returns on those. So investing, across stocks, bonds, and real estate just gives you a little bit more of a diversification. Real estate tends to do a little bit better than bonds when interest rates are rising, and it's kind of a nice in between for those returns of stocks and the safety of bonds.
Mhm.
So yeah, even someone that's getting ready to retire, maybe 30 or 40% in stocks, and 30% in bonds, and then the rest in real estate, in those real estate investment trusts. Uh, that's going to make sure that you've got that cash there, that protected cash there when you need it with the bonds, as well as having that growth that you're going to need for 30 or 40 years. Sure.
Exactly. Was there another rule you wanted to give us related to this?
Uh, you know, I guess more of a bonus, right?
Okay.
So if you're wanting this goals based investing strategy, and you want to just not worry about your money, then you're going to be mostly in those broader based funds, those ETFs. Investing broadly across the market, so you make those market returns, which, as we've seen, is actually really great. But say you want it, you still want that excitement a little bit. You still want to pick stocks. You're still you're still thinking maybe you can beat the market by a little bit. So what I like to use is called a core satellite strategy, and basically that's saying you've got a core portion of your portfolio, which is 70, 60, 70, 80% of your money, right? And that is going to be in those broad based funds. That's going to be in your broad based your stock market fund, your bond market fund, and maybe a nice diversified real estate investment trust, right? To give you good market exposure to those three assets. Then you take the other 20%, or the remainder, basically, of your money, and that's in the satellite portion of your fund. So think of this core as your planet of funds, and that's the most of your portfolio, and then these satellites that kind of revolve around that, and that can be in individual stocks. So what this does is, this does a couple of things. Actually, you've got 20% of your money in these individual stocks, so it's a much more limited pool of money to invest. Well, if a single an individual company crashes or doesn't do too well, it's not really going to hurt your portfolio too much. If each individual stock has maybe a few $1,000s in it, and is maybe 2 to 5% of that satellite portion, then it's really not going to hurt that whole portfolio. but it also keeps you from, having to search so much for stocks. I see people that have all of their portfolio in stocks, and you know, and they're constantly looking for new stocks because they have so much money they have to invest. Well, if you only have maybe 20% of your total wealth in these individual stocks, then maybe you only have 10 names. Maybe you only have 10, or at the most even 15 companies that you're investing in individually. So it just makes limits you to only the best of breed stocks that you really care about, that you really think have potential.
Yeah, for sure. I do invest in a few stocks on the side, especially for dividends. But one thing I won't touch is technology stocks, because I can't keep tabs on them. A technology company can
Sure,
come and go
sure.
so easily, even the biggest ones. So I just find it a lot easier to
Well,
avoid that completely.
sure. And it's interesting you say that, because one of the biggest misconceptions in stocks is, something Peter Lynch said decades ago, actually, is invest in what you know. And
Hmm.
everybody takes that to think, okay, well, if I'm going to Walmart, then what am I putting in my basket?
Yeah.
So I'm investing in Campbell's chunky noodle soup because I like the soup. Well, no, that's not exactly what he meant. He meant, invest in what you have deep experience, deep professional knowledge. If you work in the food packaging industry, then you have an intense and detailed understanding of how companies are competitive in that industry, and you've got almost like insider information on which companies are going to be the best within that sector. So it's not quite enough to like chicken noodle soup to be investing in Campbell's. You have to have that deep knowledge. And for most of us, sure, I don't invest in individual tech stocks because I am not a tech guy. I've never worked in technology, and I really don't understand a lot what makes a company competitive. So yeah, within that, I just invest in maybe the sector fund, the technology sector fund.
Makes sense. Well, this has been great. Can you let everyone know where they can find you online? I know you're in a lot of places, just like I am. So go
Sure.
ahead.
Sure. Well, I've been blogging for a little over 5 years. I've got 4 websites, all within that personal finance niche. So I've got Pure Finance 101, which is my personal finance site. I've got PureLoansOnline.com, which is more of a paying off debt and debt site. Then I've got MyStockMarketBasics.com, which really shares these rules on investing, and really the basics. Not so much the stock picking and how to beat the market, but those basic investing rules. And then myworkfromhomemoney.com, which really kind of chronicles my experience over the last 5 years in building these online businesses. But this last year, it's been what I've really been focusing on is that YouTube channel. It's called Let's Talk Money. It's on YouTube, and in 1 year, I've grown into a community of a little over 47,000 people. And it's great, that feeling of face to face that you get, that I never got the kind of engagement with the blogs, because you're right in front of people, and it's really a great feeling to be able to connect with people like that. So I'd love to see people join the community, and we really talk about everything I talk about on the blog. So it's a one stop shop for beating debt, making more money, and just making your money work for you.
Yeah, those have been great videos. So everyone should head over there and check you out on YouTube. And if you're watching this on YouTube, even easier, we'll put a link in the bottom.
Step on over.
Thanks for being on the show.
Awesome, I appreciate it. Thanks, Tom.
Thanks, Joseph, for helping set the record straight on these stock market lies. You can find the show notes for this episode at MapleMoney.com/Joseph Hogue, or check out all the episodes at MapleMoney.com/show. Have you entered the MapleMoney 10th anniversary $1,000 giveaway yet? If not, head over to MapleMoney.com/giveaway and enter before the March 2nd deadline. Thanks for listening to the show, and I look forward to seeing you back here next week.